Hello, everybody. My name is MJ the Tutor, and you are listening to Accounting Makes Sense, an MJ the Tutor podcast. This podcast focuses on helping accounting students all over the world by offering a quick warm up on various accounting and business topics that hopefully leads to the generation of bigger discussions and conversation. So, I've been covering this series for a couple of episodes now, and today we've reached the final one. Throughout the series, we've discussed consolidated group accounts and some of the related accounting standards that surround it. To wrap things up in this episode, we'll focus a little bit more on understanding how companies come together, and we'll also look at how different ownership levels affect consolidation. I think it's a fitting way to conclude the series, as understanding the different levels of ownership and control bring everything together for group accounting. To explain this in more detail, we're going to use something familiar and simple. We're going to use a local pharmacy, one that's been around for many years and has a steady stream of loyal customers. So imagine that there's a neighborhood pharmacy you've always trusted, and one day you're given the chance or opportunity to actually invest in it. How much control or influence you have will depend on how much of the business you own. So let's look at our first example here, which is minor influence, anything with less than 20% ownership. So let's say you decide to invest 10% in this neighborhood pharmacy. At this level, you're just a passive investor. You're not involved in decisions about which medications to stock, staffing, or pricing decisions, nothing like that. From an accounting perspective, this type of investment is treated under IFRS 9 as a financial asset. You record the investment at fair value, and any changes in that value flow through your financial statements. But there's no consolidation because you're not involved in running the business. You benefit if the pharmacy does well, but you're not making any of the calls. I'll try to circle back to fair value methodology once we've gone through all the ownership scenarios. I think it's important to actually know how this fair valuation works in order to understand how you value this type of investment. So let's go on to our second type, which is significant influence. And here, this is between 20% to 50% ownership of the business. So in our pharmacy scenario, imagine you've increased your ownership in the pharmacy to 30%. So at this point, you're no longer just a passive investor. You now have a say at how the business is run, even if it's still quite limited. You might get a seat at the table during strategic discussions, and your opinion starts to carry some weight. This level of involvement is known as significant influence, and it's accounted for using the equity method under IAS 28. You still don't consolidate the pharmacy's financials, but you do recognize your share of its profits or losses in your own statements. In this case, the pharmacy is referred to as an associate, and you'll likely see a line in your books labeled Investment in Associates. So I'll walk you through the equity method as well in more detail toward the end of today's episode, and I'll combine that with the fair value method. Alongside the significant influence, though, I want to actually broach another concept that is worth mentioning here, which is shared control. This really brings us to joint arrangements. These happen when two or more parties share control over a business activity. Joint arrangements are categorized into two types. You have your joint venture and your joint operations. In a joint venture, you and the other party recognize your share of net assets and profits using the equity method. In a joint operation, each party recognizes their direct share of the assets, liabilities, revenues, and expenses. Now, let me explain this a little bit simpler by using the pharmacy example. If you and another investor jointly own the pharmacy and control the business, and decisions require mutual agreement, that might be structured as a joint venture. You'd recognize your portion of the profits, and he'll recognize his portion of the profits. But let's say now you're each directly responsible for specific aspects of the business. So for you, let's say you're managing procurement and inventory, while your partner oversees sales and staffing. So this may mean that this type of arrangement is classified as a joint operation, where each of you report your respective share of the pharmacy's financials. So let's look at our third type of ownership, which is control. This covers more than 50% ownership, but not quite 100%. So now, let's look at our pharmacy. Let's say you then acquire and become 60% owner of this pharmacy. At this point, you have control. You're making the key decisions, choosing suppliers, setting medication pricing, overseeing staff, and steering the business strategy. This is where IFRS 3 come into play, because now you're dealing with a business combination. Under IFRS 3, owning more than 50% of a company typically means you have control. That means you're required to consolidate the pharmacy's financials into your own. This involves recognizing all of its assets, liabilities, and equity on your books. If you paid more than the fair value of the net assets, you record a goodwill. If you paid less, you may recognize a bargain purchase gain. Consolidation allows you to report the pharmacy as if it's part of your own business, because operationally, it is. In this scenario, the pharmacy is classified as a subsidiary. Any investment where you hold over 50%, up to full ownership, falls into this category. Now, if you don't own 100%, the portion you don't own is referred to as a non-controlling interest, and that gets presented separately in your consolidated financial statements. It represents the share of the pharmacy that still belongs to other investors. So now let's look at the last type, which is full ownership, and this is when you own 100% of the business. So let's say in our pharmacy, we've decided to purchase everyone's shares and we are now full owners of this business, 100%. That means complete control. Every decision is yours, from inventory sourcing to pricing strategies and even relocating or expanding. So under IFRS 3, since you now own the entire business, there's no need to account for any non-controlling interest. That is actually the only difference here. Exactly what I said earlier, you're going to consolidate each line into your financial statements because now you actually own the whole business. You consolidate the pharmacy's financials in full. Any goodwill, any bargain purchase gain from the transaction is fully recognized in your books. So I didn't mention that I was going to circle back to fair value method and equity method, and I was going to try and explain these two terms. So the fair value method applies when you hold a relatively small stake in the company, typically less than 20%, and you don't have significant influence over the operations. In this case, the investment is reported at fair value on your balance sheet. Any changes in the value, whether gains or losses, are recognized either in profit or loss or in other comprehensive income. Under this method, you don't actually account for the investee's actual performance. You're just recording changes in the market value of the investment. Another thing, dividends received are treated as income under this method, and usually this directly boosts your profits. On the other hand, the equity method is used when you have significant influence, usually ownerships between 20 and 50%. This means you're involved in key decisions, but not in full control. The investment is initially recorded at cost and then adjusted to reflect your share of the investee's profits or losses. These are reported in your income statement. Importantly as well, dividends received aren't treated as income. They reduce the carrying amount of the investment on your balance sheet. Over time, the value of the investment also reflects your share of any changes in the investee's equity. In conclusion, it's essential to understand the different types of levels of influence, control, and ownership so that you can accurately reflect your investments in the books of accounts. You also have to understand these different business combinations or, structure so that you are transparent, consistent, and aligned with IFRS standards, giving your stakeholders a clear and reliable view of your business structure and investments. And that is it for me today. I am your host, MJ the Tutor. Thank you for joining me today. I hope you've enjoyed this episode, and I'll see you again next time. If you found this helpful, please be sure to subscribe or follow to catch the release of the next episode. You can also connect with me on various social media like Facebook, Instagram, X, Threads, BlueSky, YouTube, under the handle MJ the Tutor. You can also visit my website, www.mjthetutor.com. Till next time. Ciao for now.